Good afternoon.
Good morning, good afternoon, or good evening, depending on the time you're listening to this program, to this interview. Today I have the honor to be here with great entrepreneurs, managers, partners of asset management companies. I have at my left side Luis Fernando Figueiredo, who is CEO of Mauá Capital and a manager and an economist there. Luis, thank you for being here with us.
It's a pleasure.
I have the pleasure to have here Guilherme as well, who is a partner, senior and founding partner of Jive Investments.
Thank you, Samuel.
Who is supposed to be the host, but I'm trying to do his
You're
work.
doing such a great job, I wouldn't even try it.
I have here Tony Volpon, who's partner and chief economist at WHG Investments. Tony, thank you for being here.
Thanks a lot.
And we have here the vice chairman of Nasdaq, Bob McCooey, right?
Yes.
Did I get it right?
Yes, yeah, you got it pretty good.
Awesome. Well, my job here is talk as much as
Little.
As little as possible.
as possible. Anyways, so I wanted to start with Tony. Tony lives in Washington. He was a director for our Brazilian central bank previously, and I would like to hear from you a brief description of your how do you see the international environment currently, and how does that affect Brazil? I know it's an open question.
It's a big question.
But if you could summarize the main topics.
Yeah. So I think we all know what we're going through. We're going through a moment of extreme global inflation. Obviously, the combined impacts of what happened during the pandemic, plus the excesses of monetary and fiscal policy, have caused this inflation. So now, sort of on the other side of it, we're having all these central banks addressing this issue: the Brazilian central bank, the Fed, the ECB, pretty much everybody except the BOJ is doing something about that. So we're in this moment of global monetary tightening. Makes very rough for markets. Markets never really do well when central banks are raising rates. And I think the big debate everybody's having in markets right now is, how far will the central banks have to go, and more specifically, the central bank that really matters, which is the Federal Reserve in the U.S. How far are they going to have to go in terms of really bringing this inflationary situation under control? In the month of July, we had a very good month for risk markets overall, because I think the market, based on certain signals coming from commodity markets, certain signals coming from supply chain indicators, there's a sort of renewed optimism that perhaps the Fed will not have to do that much in terms of monetary policy tightening. So if you look at forward interest rate curves in June compared to July, so in June you had a peak Fed fund rates projected at being around 4%. Now it's around 3.25%. And if you take sort of 2.25%, 2.5% as being an estimate of what the neutral rate is, the market is actually seeing rate cuts in 2023 below neutral. So the fixed income markets seem to be either pricing in a recession, because obviously a recession could cause inflation to fall down fast enough for you to actually have rate cuts in such a fast period of time, right? But then you look at equity markets that also had a very good July, and they don't seem to be pricing in a recession, given the fact how high they've come. So one of the things I think that we're seeing now is sort of a divergence between what equity markets are pricing in and what fixed income markets are pricing in. So, this is it's not that uncommon. Often there is sort of this divergence. Markets are forward-looking. Markets always pricing in some kind of future, right? Discounting some kind of future. And I personally believe they're sort of discounting different futures. Both of them sort of positive. You could say that perhaps they're both pricing in an extremely soft landing scenario where inflation falls very quickly without a recession. So the Fed doesn't have to hike rates that much. They can already start cutting quite quickly. Chair Powell, in some of his statements, including during the press conference at the last Fed, he kind of backed that up in a little bit. He has said at certain points that insofar as there are sort of supply side elements to the current inflation surge, that's why inflation went up so high very quick. Maybe as you fix the supply side, it comes down very quickly. Right? So I think there is this optimism that we can have a very soft landing next year. I'm very skeptical. We had Larry Summers here at the conference this morning. He's very skeptical. The way I read the situation is that there's a lot of inertia already in inflation in the United States. and you really can't break that inertia without doing some kind of damage to the job market. And usually that kind of damage causes at least a shallow recession. So I don't think you can avoid a shallow recession scenario in the United States. But I do think markets have gotten, markets are volatile. They're very optimistic at this point. Fed speakers over the last few days are trying to take some of the dovishness back from the market. We've had a lot of speakers over the last few days. And actually interest rates have gone up. Curve is already quite inverted if you look at the spread between 2 and 10 years. But equity markets keep rocking on, and maybe it's because it's summer, maybe because everybody's at the beach, I don't know. So it's going to be a pretty exciting couple of months when everybody comes back from the beach, and we'll see what the markets will do. Sorry?
It's the Aperol effect.
Yes,
sipping
exactly.
an Aperol at the beach and it doesn't look as bleak when you're doing that.
Exactly.
But Tony, shouldn't we all listen to Larry? Because he's the only one who's been, well, I won't say he's the only one, but he's one of the few who's been right over the past year.
He's been right.
He said this, he said everything a year ago, and it kind of played out exactly the way that he said it, number one. And then number two, I guess the things in the U.S. is defined as to how you define a recession, right?
Right.
I've never seen a situation in my life where you have what is definitely a technical recession, but suddenly out of the our government in the U.S. they're saying, well, it might not be a recession because we're going to back this out and back that out and talk about a bunch of different things. It was kind of amazing to me why we just don't call it a recession.
In
because
fact,
it's not. I don't think it's going to change anything.
So here's an interesting historical fact, right? Every time you've had a technical recession in the United States, you end up having an actual recession dated by the NBER, right? So there's the dating committee. National Bureau of Economic Research. They sort of decide officially what's a recession or not. The only exception was right after the Second World War. So in 1947, there was a technical recession, 2 quarters of negative growth, but the NBER didn't call that a recession. That was the only period the only instance where that hasn't happened. So it has a 100% hit rate, again, except coming right at the Second World War, very exceptional circumstances. Perhaps, the pandemic is also very exceptional. I think what's happening is, again, my read is, you're having, we've had the largest tightening of financial conditions that you've had really in history, but coming from extremely easy levels. So when you look at the level of financial conditions, you look at the Goldman Sachs financial condition index, for example, it doesn't seem that tight, but it was so loose and it came up so fast, right, that you can already see the interest rate sensitive sectors of the economy already beginning to suffer. So housing suffering, manufacturing is beginning to suffer. And I think it's a classical kind of business cycle response. Sectors that are more interest rate sensitive begin to weaken, others don't, and then it kind of spreads, right? And eventually the last real sector that really feels it is the job market. So it may be the case that the NBER takes about 7 months on average to call a recession, because they want to see the entire spectrum go through. I think we're already in the spectrum. It's already started. It may well be that the NBER will call the recession as having started perhaps in May. Or April.
Yeah, but the thing is, if we don't have, the labor market getting calmer, inflation will not go down.
I think that's Larry's point.
The discussion about recession, what we need is to cool down this demand. How we do it, maybe with a harder recession or not, we don't know yet. But the thing is, before we didn't have to cool down so much as we need right now. So it's a different story, no?
Yes. So another sort of historical tidbit, if every time the unemployment rate goes up by 0.4 versus the 3-month moving average, you also have a recession. Mm-hmm. Right, so the unemployment rate in the US is at 3.6 right now. Estimates of the neutral unemployment rate around 4.1. So just to get to neutral, you already get enough of a hike in the unemployment rate, which again historically has led to recession. We all know monetary policy is a very blunt instrument, right? You can't just cool off demand. It's just, this sector's super hot, so let's do policy is only going to affect that sector, but not that sector. That doesn't work. It's like monetary policy, like carpet bombing. You just blow everything up together, right? And so, again, I do think you're going to have a recession. The positive side, though, which I somewhat agree with, is you don't seem to have kind of the financial imbalances that you had, for example, in 2007, 2008, where a recession also became a financial crisis, which then caused a really deep recession, right? Because one way to read that episode is the economy began to sort of turn over in 2006, especially housing, which was in a bubble. And then, but because of all the excess leverage, especially within the banking system, you eventually had a crisis. You had Bear Stearns, you had Lehman, and then that became a really deep recession. So what starts off as a light recession can become a deep, destructive recession if you have some kind of financial crisis. When you look at the banking sector, when you look at everywhere basically, right, you don't see the type of leverage that you had back then. Banks have a lot of equity capital. I mean, there may be some excesses on the corporate sector, certain sectors, whatever, but at least, I mean, the judgment of a lot of people who've looked into this is that you don't have the kind of financial fragility you had in 08. So maybe we can get away with a, more or less garden variety recession like you had in 2001, like you had in some other episodes, If we can avoid 2008, that obviously would be great.
And Bob, how the perspectives from the exchanges, how you see things there? You agree with Tony?
Well, I agree with pretty much everything Tony has said, and I've been following Larry Summers. Unfortunately, my investment accounts don't mirror the fact that I've followed Larry Summers as much as I should have, because if I had, I'd be in a much better position than I am today. But I think that what happened, at least in the equity markets, was from how volatile and negative we had in the early part of the pandemic in 2020. Every day from May of 2020 through January of 2022, the market went up every day. And so nobody wanted to sell because you were worried that if you sold today, tomorrow you'd wake up and the market or whatever you sold was going to be up and you'd have seller's remorse. And so nobody sold, and the market, and there was just more and more demand. You overlay that with the fact that over the past decade, really equities has been the only place where you could get some substantial growth. There was no yield in the fixed income market. So you had to be in equities if you were going to create long-term wealth, and you were going to grow your nest egg, as they say. And so that's what fueled a lot of what was going on in the equity markets. And suddenly you get all the things that Tony's been talking about, and Ukraine war, hawkishness at the Fed, rise in interest rates, the tight employment, supply chain, all of those which created the situation that we saw in the first quarter. The markets reacted kind of the same way over the past couple of years too. I mean, we had record years at Nasdaq with 316 IPOs in 2020. We had 752 IPOs in 2021, which is an all-time record for Nasdaq. So we saw people using the equity markets and saw valuations at very high levels, both public valuations and private market valuations. When markets turn, which they clearly have over the first half of this year, public market valuations then drive the private market valuations. And so those companies
drives them down, right?
Drives them down. And
Yeah.
obviously the way that the trajectory of where the markets have moved to. And so those companies that had been valued, and a number of who did substantial raises at very high valuations last year, recognize that there's no way for them to get that valuation in the public markets because their public comps are trading at much lower PE ratios than they were within the past year. And so when you benchmark them against an already public company, there's no way someone's going to pay a higher PE ratio for an unproven private company going public than they're going to pay for an already proven public company. And so that's the challenge in the markets, is the fact that there is a tremendous backlog of companies. I mean, our pipeline, not just from here in Brazil, I mean, we had a half a dozen companies between the last couple months of last year and who delayed their offerings, and then others that were scheduled to go in the first quarter of this year, who are still preparing, but there's no active preparation because there's no real market to receive them. And certainly in the U.S., other companies, both domestic companies and from other parts of the world, the market is just not there. And the challenge is, when will the market be there? And the in my opinion, the only way to get the market to be there is to have somebody, some company, or a couple of companies restart the market, to go out, to raise money, to be successful, to have a successful offering, and those give the confidence to bankers, to financial sponsors, and to executives that there's a market there for their offering, and then hopefully that reignites the IPO business. But it takes some courage and some determination by companies to go out and do that. And it's certainly not going to be, as we're discussing, it's certainly not going to happen during the summer. So the U.S. markets traditionally get reinvigorated post-Labor Day, so we'll be looking at that September, October timeframe, hoping that the positive momentum in the markets over the past month or so continues, which might give the confidence to those companies to try and come public.
Yeah, you mentioned, Bob, something that piqued my interest here, and I wanted to pose a question both to you and to Tony. We talked about a little bit before we came into the studio, but in 2020 and 2021, everything went up, right? All asset classes went up, but one of them perhaps went up faster and farther than all else, and those were digital assets. Everything digital was overhyped and overvalued. At some point, Bitcoin was the second.
Maybe not overvalued. You don't. We can always say that in the future, right?
Yeah. No, you're absolutely right. That was a shortcut that I was taking.
When we had one of the platforms come in and talk to the senior team at Nasdaq years ago, Bitcoin at that point in time was $1,000 a Bitcoin, and within a few months afterwards, it went down to $250 a Bitcoin. Wow. So I guess at that time, when it's 250, you'd say, oh, well, at 1,000 it was overvalued, right? I guess at 68,000, that 1,000 wasn't that overvalued.
That brings back what Howard Marks said yesterday about markets going from total complacency to total panic, right? And maybe that's what happened here as well. But the point is, those assets went up very fast. The demand for them went up very fast as well. There was a lot of talking about a new way of doing finance, about decentralized finance, and how that would mean the end of what we call traditional finance as we know it. And all the major financial institutions started their blockchain initiatives, digital asset initiatives, digital custody of assets, and so on. So everybody got into the bandwagon. Everybody was very
just
excited
to help you
about it.
with your logic. In Brazil, we had at a certain time more investors in the digital assets than in the stock exchange.
Yeah,
like
insane.
4 or 5 million.
Yeah, true.
It's everything happened very quickly. And there was leverage into that system as well, because people were borrowing against digital assets. And then the market changed as a whole, but it changed more dramatically for that particular space. And a lot of high-profile bankruptcies, Celsius and a few others happened, and obviously the price of Bitcoin and the major digital assets also collapsed. And whether they're overvalued or not, it's a different question. But the truth is, they went down, and those markets are now much more correlated with the traditional financial markets than they used to be before. So my question first to Tony, and everybody's welcome to give their opinion, is can digital assets and what happens in the decentralized financial markets really move the needle into the traditional markets and be either a driver of a recession or the locomotive that maybe helps us get out of one if we do get into a dated recession, as Tony was saying?
Sure. I mean, first thing, the kind of AUM of digital assets, even at the peak, was a fraction of so many other public markets. So, the wealth destruction that happened there was pretty vicious, but it's not something that I think is a macroeconomic concern. And also because there is this sort of in this cycle at least, I think the future may be quite different, but there isn't a lot of overlap between, DeFi and TradFi, right? So it's pretty separated kind of ecosystems, and so then when one fell a lot, it didn't really impact all these other ones. On the correlation point, I tend to see digital assets as a type of technology. and so it should have a high beta to anything that's technological. So, you know, if all the Nasdaq tech companies are going down, you know, the stuff is going to go down and buy more, right? Because of the advanced nature of these kinds of technology. So I never bought the argument that, you know, Bitcoin specifically is some kind of, you know, hedge to the market or inflation hedge or anything like that. I think that's you know, it doesn't understand the technological nature of what this sector is. I am very optimistic that a lot of good technology is going to come out of there, but obviously there has to be, you know, proven use cases. And you know, in my dealings with DeFi, and I was telling you, my wife works in this sector, so I've had been to a lot of these Bitcoin conferences and so on. You know, you see of everything. You see, like, they're Ponzi schemes. You know, there's stuff that's really, you know, you know, it's fraudulent, and then there's real stuff, right? And it's a mixed bag of things. And you know, one of the things that I think is negative is that the lack of regulation, especially in the United States, you know, the sort of slow walking of the regulation is bad because it allows the bad stuff to flourish, right? Damaging what's the good stuff. Everybody who's serious in the digital asset space wants good regulation. Everybody wants good regulation. They don't want regulation that kills the sector, obviously.
It's a hard balance to find.
Yeah, it's a hard balance to find, but it needs to be found. And so hopefully over the next few years we will find that balance and the sector will grow. And I think it is going to, you know, bring a lot of improvements. It may not be this sort of like world-changing revolution, you know, the maximalists, you know, kind of think. But I think there's a lot of good stuff being done on Web3 and all these other technologies.
Well, I think for us, one of the things that a lot of people don't understand about Nasdaq as a publicly traded company ourselves, like we're a $29 billion market cap publicly traded company, and when I joined Nasdaq 16 years ago, we did two things. We listed stocks and traded stocks, basically all we did. Now in our listings business, we have services that we provide to companies. In our equities trading business, we have equities, options, futures, commodities, central clearinghouses. We have a large index and data business. And we have our market technology business that builds trading platforms for 130 different exchanges around the world. We're the largest in terms of providing regulatory technology. And we bought a company called Verifin about 2 years ago, which is the largest anti-financial crimes business for banks around the world. So we do a lot more, and in that market technology and the index and data business, we're doing a lot of work with companies like XP. We're doing with companies like Hashdex in terms of helping them with their with the way that they're doing Bitcoin and futures, and you know, there's partnerships that we can create that don't have to be about Nasdaq running a trading platform. We as an organization can do a lot to help the entire global capital markets. It's one of our core principles to support the global capital markets, that we can do that without having to do it ourselves. We can help others around the globe to be able to do that. And we think that this is an amazing asset class that is going to continue to grow. It's one that we all should be focused on. And so that's why we've hired technologists, we've hired strategists, we've hired people in all of our different business areas to try to make sure that we as an organization are focused on it not just for us, but focused on it most importantly for our clients. Today, we can actually provide one of our exchange partners around the world with a blockchain-based matching technology to run their exchange. In the US, we focus on microsecond execution. Most places around the world don't need microsecond execution. If you trade and use blockchain and it clears and settles in 1 second on the blockchain, that's pretty good. That's really not a big deal. That really works. And so for a lot of exchanges, that will work. And so for us to be able to offer that, we think fundamentally it becomes not just about the cryptocurrencies or the NFTs, it becomes about the underlying blockchain technology, which we've embraced, and we've actually done end-to-end transactions using the blockchain, including distribution of funds on our Nasdaq private market. So we think it's really continues to be, as you said, Tony, like early innings for this, and we play the long game. So we're going to be in it for a long game across a number of different ways where we can partner in order to drive value for the entire financial ecosystem.
I'd like to make a question about Brazil, but for Tony is in one way, and for you, Bob, another way. From the macroeconomic perspective, we have elections 60 days from now, and
yes.
Our central bank is almost in the end of the interest rates raise cycle. We don't know, but if you could summarize for us, what's your view about Brazil right now? Are you optimistic or not? And Bobby, afterwards, if you could talk, what's your view for Brazil, for Brazilian companies that has followed with IPOs in Nasdaq or the other partnerships, as you mentioned, hashtag. So 2 questions here about Brazil, one from the macroeconomic perspective, another one from the micro perspective. Yes, Tony, please.
Yeah, so truth of the matter is the economy is doing much better than people thought. So a lot of people, even our economists, were expecting like a down year, 0 growth, slightly negative growth this year, and we're going to grow something around 2.5%. Between 2 and 2.5%. I think a lot of it has to do with the commodity cycle. Brazil is a huge commodity exporter. You know, we have blessed lands here in Brazil, and I think the market sometimes kind of misses, you know, sort of misses some of the linkages between higher commodity prices and stronger growth in the economy. Especially, for example, you know, all the talk about the fiscal situation in Brazil, a lot of fears about the fiscal situation. The truth of the matter is, and it's something Minister Guedes said yesterday, and he's totally correct, there is an excess of, there's higher tax revenues because of what's happening in the commodity cycle. And we can get into a lot of different arguments and scenarios about how long is this going to last, is it more structural, whatever, but the truth of the matter is the money is there, and I have absolutely, I don't see anything wrong, especially because many governments around the world are doing, about giving some of that money back to society, either by cutting taxes or through some of the transfer programs that we're seeing. So I think the market in Brazil is always very, we do have a fragile fiscal situation. I don't want to sort of say that we know Brazil doesn't have fiscal challenges, but I think the market tends to overestimate or get too focused on the fiscal stuff and kind of ignore everything else. And I think some good things have happened this year. I think there's been, and again, Minister Guedes spoke about this, there were some reforms done, there were some partnerships done. You know, there is a stream of investments that's going to happen over the next couple of years, something like $800 billion, almost $1 trillion. You know, these things help, right? So I think the economy is in much better shape than it was a few years ago. It's been a bad decade for Brazil, right? But some problems were solved. Obviously, we have an inflation challenge that needs to be addressed. But if the next government, whoever, you know, the next government is, right? If they just sort of let these things play out and don't screw it up, you know, I think we're actually going to have a couple of, you know, better years in Brazil. So I am more optimistic about Brazil as a country than I think the consensus, at least the consensus in Brazil itself, which again tends to focus too much on the fiscal and get too pessimistic about these things.
It doesn't matter if Bolsonaro or Lula.
No, I mean, I don't know. I'm not saying it doesn't matter. It matters what they will do, right? So again, if they don't, what I'm saying is if they don't actively screw it up, we'll have a couple of good years. Hopefully they come in and they can do more better things, right? So that, you know, you can do positive things, you can do negative things, and you can kind of do nothing. What I'm saying is if you kind of do nothing, the momentum is there to have a couple of good years, right? To have growth around 2-3%, right? And sort of let that play too, especially if we can avoid a really deep recession in the United States. I don't think commodity prices are going to crash, even if there is a recession. I think there are supply constraints on the commodity side, which are global and ongoing, right, for a lot of different reasons. So I do think we are in a commodity super cycle, and it's a positive cycle. And so these things will play positively for Brazil. Again, hopefully the government comes in and doesn't screw things up, right? So for the government, if we had like American-style gridlock, things would be okay, right? Hopefully we get a government that does some positive things, you know, whoever wins the election.
So I first came to Brazil 9 years ago, and at that point in time, Nasdaq had a grand total of 0 listings. There were no listed companies from Brazil. We had a number throughout Latin America. We had our kind of the flagship listing, which is Mercado Libre, which certainly is a big company here in Brazil, but headquartered in Argentina. So we had no real business here, and our U.S. competitor had done very well over this prior 25 years of accumulating a number of listings. But what I like to talk about is kind of the Nasdaq generation, and I thankfully came to when I came to Nasdaq 16 years ago, I was hitting the stride of the Nasdaq generation of those companies that had grown, had been successful, those that had come and stayed with Nasdaq, and now we've got the 7 largest companies in the U.S. capital markets. And it's amazing to be here today because we had another technology company from Brazil, Sematix, list on Nasdaq just today.
How many Brazilian companies are listed today?
So there's two ways I'd have to answer that, Tony, because we have a number of SPACs that are formed by sponsors in Brazil, and there's about 10 active SPACs. Okay. And then we have, I think Sematix will make 17 or 18 listed companies, including, obviously we're here at the XP conference, XP being our largest company from Brazil. But thus far this year, we've had 3 SPAC listings from Brazil. We had Banco Inter last month. We had Sematix, which was a D-SPAC, merged with Alpha Capital's SPAC and became a public company on Nasdaq. And we've continued to see whether it's education technology companies, straight technology companies, fintech companies listing on Nasdaq. And we think the future for the capital markets here is really bright. I think sometimes when Nasdaq is in market, people think that we come to have all the companies from a certain market come and list on Nasdaq. And that's truly not the case. The case is that there are going to be a number of companies in each market around the world, and I've run our Asia Pacific business since 2008. And we've seen companies from China, Southeast Asia is now a very hot area for IPOs, but those companies are proactively choosing to list outside of their local market. And when a company chooses to list outside of their local market, no matter where that local market is, we firmly believe that they belong on Nasdaq. And that's what we come to Brazil or Tel Aviv or Singapore to talk to companies about, is that we really think that we have a strong value proposition. Companies are technology companies, fintech companies, technology-enabled companies. Our largest sector is healthcare. So though we're known and famous for our technology companies, and it's our largest sector by market cap, our largest sector by number of companies is healthcare, especially biotech, the companies that will allow us all to live to be 150 years old in the future. But we have this robust list of companies, and people love to be associated with the values of a Nasdaq companies. Innovation, growth, entrepreneurship, those that are dreaming to do more, those companies that have changed the world over the past 25 years. And that's why we're so excited by a growing ecosystem of these entrepreneurs in Brazil that we hope at some point in time will build a business big enough to consider to list in the US. And when they consider to list there, we certainly are going to make a hard push why they should list on Nasdaq.
Oh, that's really great. We really hope that many Brazilian companies grow, become innovative, become entrepreneurial, become eligible and large enough to list in the Nasdaq.
Just like Jive.
Well, that's not a conversation that might be too far away. Who knows?
Awesome.
We're obviously very excited about what we're doing with Mauá now. We're joining our companies and becoming a lot bigger because of that. And who knows? Maybe the end game will be, or at least one of the steps into continue our story will be through a listing. But let's not talk about that now. I really wanted to thank.
For sure, if it happens.
You'll get a call.
First call.
You know who to call. Right.
You'll get a
Your
call.
first call.
Bob, thank you very much for joining our panel. Tony, a pleasure always to hear you.
Thank
Luis,
you.
some excellent comments. Always really a privilege to have you on board with Jive and Mauá together. And Samuel for hosting all of us here at XP. So thank you so much.
Thanks a lot.
Thank you.
Thank you, guys.